14 April 2023, Friday. Thank God it's Friday, and that's MAO with Cal once again. Now, boom, bust, boom, cam. All right, I think this is really summarized everything, but I believe too. I believe that now we're having a boom time, and very soon we have the bust, and then after that with a big boom. And apparently Morgan Stanley, Mike Wilson is also in this camp right now, and he's still staying in his view of the market coming down. And incredibly, Goldman Sachs also came in today and says that, right, the NASDAQ could be near a peak soon. So likely there might be some profit taking. So what do you think, guys? I'll give you more in details very shortly. Let's go. Now, once again, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, first of all, guys, remember today is the last day to put in your comments, all right, so that I can lucky draw you guys tomorrow. We are going for the 19th of April Omakase Lunch, and that place is at this Golden Mile Tower. We're going at about 11:30 a.m. So you need to give our time for that because it's Omakase. So we try to be there early so that we will have the best of the whole time, right? Okay, so for people, all right, thank you guys for keep on sending me messages and comments and to win the chance. Thank you so much. And you can see that I took the initiative to make sure I reply every one of them. All right, so today is the last day before tomorrow. Right, then tomorrow about morning time, that is where, or if not late afternoon, we're going to do the spin the wheel lunch with Cal. Yeah, quickly do it right now. Okay, let's recap what happened last night. Wow, the Dow Jones up by 383 points. Wow, what a whoopee here. All right, so the thing is because the PPI data came out better than expected, and of course, the market is pretty happy with that. And the NASDAQ rallied 261 points, and S&P back up again to 4150 region. Now, one thing to note of is that Amazon, Microsoft, Apple, everyone was going up, but the thing is, you look carefully, the finance side is not really doing that well. JP Morgan was flat by 0.38, and of course, Bank of America is up by 0.28. So with the 300 point to 400 point rally, yet the banks are not moving, this is something that I don't like it. So that's why I feel I need to express my concern today. Now let's look at the PPI data. Well, it's a 7.3% drop in margins for machinery and vehicle wholesaling was a major factor in the March decrease. So take note of that, it's the machinery and the vehicle wholesaling. So we can see from here itself, right? Conversely, prices of the gas room rental rates up by 4.6%, and indexes for food, retailing, and transportation also advanced. So this is something that's similar to CPI data. If you're just only looking at a certain part of it, it did decrease significantly, but the main necessity area like food, like energy, all this itself, right, are not going down at all. So the thing is this, you look at numbers right now, this is quite incredible. Take a look, guys. That means that the market was looking at a 0.1 minimum, right? But the market came out minus 0.5. Wow, that means that the cost has been reduced quite significantly. And that's pretty good in line with the jobless claim, who went up slightly higher. So there was a double whammy. Double happiness, sorry, my bad. But the thing is this, if jobless claim is going up, isn't that equivalent to people losing job? And if that is the case, then isn't that nearer the recession? So depending how you see it, if you really want people to lose their job to cool down the economy, then you have to understand that the economy is going to get weaker, and then people will suffer later on. So it's going to be like, you know, both sides will give a hit, all right? But nonetheless, you can see the number pretty clear that it has came down all the way since last March, all the way from nearly 11.8 down to 2.7. So it's pretty good, pretty good. So that's the reason why the market is pretty happy with that. And the thing is then we just heard that the Fed official are saying that the recession is coming in, but you can see the market is jumping with joy. Everything is doing well. So once again, guys, do you think that fundamental and the current price action, which one is more important? Now, one thing is that very notably is that the VIX is back to 17 again, and that is a place whereby I would love to buy some VIX. Now, I know that the thing is that people have been asking, Cal, you've been calling for buying on VIX several times, although they were correct, but don't you think that this time around may go to 15, 12, 11, 7? Now, guys, I don't think so. To me, it's all right. It's very clear that we are not out of the woods yet, and the banking sector tells us a lot of it. So, of course, there are very good indicators like this one called the COPPOC, how I got it correctly, COPPOC, this buy signal. Now this thing only is a very rare technical analysis, very rare call for buy. Yeah, it's a long-term outlook, it's very constructive, and very important, it's a momentum oscillator. So you can see that almost every time when you have that particular signal, which means you see the purple line being drawn, right? Once the purple line is there, you can see the market actually goes up. Similarly here, the market went up. Similarly here, the market went up. So now where are we? We are actually here, which means that based on the past historical pattern over the last 40 years, there is a good chance that we will see the market going up again. And that's the reason why some players are buying into the market. Now, to me, I'm not going to go against this, but I just felt that we are still very well held up by some big boys, and that's the reason why. So you can see the bank momentum versus S&P now has fallen to record low level. Look at it. So the bank sector refused to embrace the recent rebound. And if you look at it, right, the S&P went up by 7%, the NASDAQ by 10%, but the bank shares are actually down by 5%. So don't you think that this is not healthy at all? Now, of course, from the people who are positive, say, okay, it's a good time to buy right now, because that means that once the market really economy recover, this one will recover quite a fair bit. Well, I will say that it's kind of optimistic to think that way. I think that this is actually a telltale sign that we should be very careful. Because now, right, the money market is still receiving a lot of funds, although it's decreasing in rate of change, but it's still $30.27 billion in flow just the last 5 weeks. My goodness, that is, this last week, only just last week alone, 30.27 billion. And in total itself, 380 billion flew into the money market. So that's the reason why this is actually not a good sign, because everybody is banking on the 5% return. So if the stock market is really can make 5%, why don't you just do that? So that is a very, very big concern right now. And because of this right now, right, we can see that the current, the push assets now is really at $5.277 trillion. So it's well above the 4.8 trillion pandemic peak, suggesting that the US commercial bank deposit continue to fall. Yes, indeed, it means more and more will draw away from the commercial banks and putting into the money market. So with that, right, you can see the dollar is coming up because everybody draws from the bank and put it somewhere else. That's why the dollar is coming down. And because it's falling, it's not a good sign, because usually a country economy, if the dollar, their own currency is not doing well, usually the economy is not going to do well too. All right. Of course, we know that it's because of the potentially relaxing the monetary tightening policy, but we all know that the main thing is that people are getting more and more unhappy with the US dollar. In fact, they feel that there's no security right now, and they think that, right, things can get even worse, which I kind of agree. So you look at it, the S&P 500 is still surging, but the forward EPS, earning per share, is not following. That's a very big problem. Now, back then itself, right, you can see the S&P actually rally here, but the EPS was actually going down. So you can see that, right, the market is definitely artificially supported. Now, by who? I don't know, but we can see from clear that the short sellers are not wrong to sell, but just that the market is even more resilient than not. And you look at it right now, right, in terms of the performance of the S&P 500, all right, you can see that we are still in the negative side. So if the numbers are still bad, right, how can the S&P be trading higher unless there's something that we don't know? So we can only see this one more incredible. We had the Fed balance sheet lowering. Now, thing is this, the most anticipated financial update, the infamous H.41, showed the world's most important balance sheet shrank by the third straight week by 17.59 billion. So the thing is why? That means that probably now the coast is clear, not too sure, but we all know that when the Federal Reserve actually do this, what will usually happen? The stock market will pull. So if you put that, the Fed balance sheet side by side with the stock market, you will know that the Fed actually is the one that pushing the stock market right now. So if they're pulling back here, kind of expected that the NASDAQ especially to drop a little bit. So that's why Mike Wilson is staying bearish, and he in fact itself, he's telling you the only reason why they are wrong right now is just timing. So let's listen to what he has to say. Mike, let's go, bring you in.
Upward your target for the S&P, or say the 3,200 bear case isn't really at play anymore?
Well, look, the way we look at the world and the markets is we have a sort of 12-month view, and then we have a shorter term kind of tactical view. And on the sort of year-end target prices, we haven't budged those because we think those are still accurate. 3,900 is our base case for year-end, 4,200 bull case, and then a 3,600 bear case. Those are in place. Okay, those have not changed. The tactical trading path, what we've gotten wrong this year is the timing of it. We don't think the path is necessarily wrong. We put those targets of 3,000, 3,300 for a trough for this cycle in May of last year. Okay, so that has not changed. But calling the price and the time, it's hard enough to get one right. To get both right, I think, is tricky. So we've been wrong on the timing for sure, but it doesn't change our view that low end of the range, that path to 3,900, we think still goes through kind of low 3,000s ultimately.
How difficult has it made your job, Mike, to see the volatility in the rates market persist to the same degree that we've seen over the past few months?
Well, I mean, I think rate volatility leads equity volatility. I mean, the rates market, I think, have moved away from the equity market view that the banking stress is going to lead to a credit crunch and probably, a situation where the Fed's cutting rates because there's a recession, and the equity market is not priced at all. So, you can place your bets. Who do you want to kind of lean with? We're in the earnings recession camp. So whether we have an economic recession or not, I think, isn't as important as the earnings recession. And we're highly confident that that's going to happen, that the earnings situation is way worse than what the consensus thinks, which is more in line with what we've been saying all along. And the banking stress only makes us more confident in that view.
Have you ever?
Okay, so you heard him. His base case right now is 3900. That means that if the market don't really move much, it should be hitting about 3900 as a base camp. But if things get worse, we can see 32 or even 3000. That's what he said. Yeah. So you can actually go online to Bloomberg and watch the video yourself, or you can do it from my link later on. So what we are seeing right now, not only Morgan Stanley is saying this, Goldman Sachs actually came in to warn about the NASDAQ. They felt that now the NASDAQ and it's moving itself is quite a what do you call overboard in a way. So in short itself, they are saying that the S&P 500 now versus the S&P model based on the liquidity adjusted investment flow, versus the S&P price return, we are actually getting a bit, divergence here as well. It's opening up. So that means that by right, usually they come together, and hence there should be a pullback back then. So in their case itself, they are looking at the buying the NASDAQ puts or the QQQ is an attractive hedge against the current dislocation. He feels that there's now this thing is a bit both of them in terms of price versus the valuation is a bit wide, and that's the reason why it's something similar like what this Mike Wilson says. And of course, you look at it right now, the tech shares and the high yield borrowing costs have diverged over the past 2 months. Usually they move together hand in hand, but now they open such a big window here. So likely, there could be a potential pullback in the market in the short term. So Goldman Sachs calling a bit of sell. This Morgan Stanley also looking to sell. What do you think? Do you think that the market will come down? Let me leave me know in the comment box. Yeah. Now the thing is, at the moment now we can see very clearly that the short sellers, the shorts who are speculating this are actually now increasing their bet at the moment. You can see that. So this is what happened before 2016. This is what happened during the 2020 mid-year, and this is now, So remember all these things. Let's just take a look with the charts, and then we can see this actually better. Okay, so they look at the chart right now, the S&P, the Dow Jones, Back then, the Dow Jones actually from the high went down by 13%, down by 2,400, down by how many points? 2,400 points, Okay, that was then. Then back in 2020, where we saw the same thing again, then the market dropped only by 9%. So here is 13%, here is 9%. So where are we now? Wow, we're still moving upwards, So if you're looking at it, that means that very soon there should be a pullback of at least minimally 10% in the market. Minimally 10%. So guys, if you count 10% right now, today's Dow is 34,000, 10% will be 31,000. And we do have a very important technical level, 31,411. So what do you think? Do you think that we're going to go there soon? Let me have your comment in the comment box. Okay. All right. So that is what Mike Wilson and Goldman Sachs has to say. But we can see the main things that the AAII bull are still not coming in yet. So that means that more players are actually on the sideway. Even the bears are not really coming in heavy. They also have pulled back a little bit. So now if the bulls are not buying, the bears are not shorting, then seriously, who's playing the market? That's why you can see that a lot of artificial pushing around pretty clearly, Now, one thing is that China has added a lot more crude oil recently, 22.5% to be exact. And this is not good because if they add so much into crude oil into their inventories, the crude oil price will go higher, and if crude oil go higher, the US will buy. So just wondering, is that why this is done on purpose, or is it because of it's a country-to-country thingy? Well, I'm not too sure, but I know that if crude oil continue to go higher to $84, that's the minimum, if not $96, as you hear me in the last MAO. All right. So with that itself, I'll end today's fundamental. I'll see you on the technical side. This is Cal signing off. Bye-bye.